You see them every day, right? Economic headlines, inflation this, interest rates that, currency values going up or down. But behind all those numbers, there's always a much deeper story. And today we're going to dig into one of those stories, a huge currency crisis, to really get at a fundamental truth about what gives the money in your own wallet its value. So let's start with the big one. What actually gives money its value? Yeah, it sounds like a simple question, but the answer? It's way more complicated than just saying the government says so, or pointing to a pile of gold somewhere. This question, it really cuts to the very heart of how our societies work, and frankly, why some economies thrive while others just seem to stumble.
Okay, so this number, this is what our story really hinges on. $128 billion. That is how much foreign cash, dollars, euros, the central bank of Turkey burned through from its national savings, all in a massive, desperate attempt to prop up the value of their own currency, the lira. We're talking an all-out effort here. And here's the kicker. After spending all that cash, the core problems didn't just magically disappear. Inflation was still a major issue. The lira was still shaky. So what on earth went wrong? To figure that out, we have to look way deeper than just the money itself.
So to solve this puzzle, we've got to start with our first suspect, if you will, the central bank. Let's talk about what a central bank is supposed to do. The ideal way to think about it is as the guardian of a country's money. Its main job isn't to make the government rich, it's to make sure the entire economic family is standing on solid, stable ground.
So what's their number one job? It's a fancy term called price stability. Really, all this means is keeping inflation, that's the rate your money loses value, both low and, crucially, predictable. It's about making sure the economy doesn't get a raging fever or a sudden dangerous chill. It's all about creating a stable environment where people can plan their lives.
And this leads to a really fantastic analogy. A central bank that has a rock-solid reputation, one that everyone trusts, doesn't actually need to spend billions of dollars putting out fires. Its credibility is so powerful that a simple statement, a clear warning, basically just clearing its throat, is enough to calm down the markets and restore confidence. See, it's about trust, not brute force.
So how do they do this? Well, they've got a few main tools in their toolkit. But here's where our story takes a sharp turn. The single most effective tool for fighting inflation, raising interest rates, was politically forbidden. So that forced the bank to use another tool, selling off that massive $128 billion piggy bank. It was basically like trying to fight a raging house fire with a couple of buckets of water because someone locked away the fire hose. And this right here, this gets us to the absolute core of the issue. This whole fight about whether interest rates should be higher or lower, it might be missing the point completely. It's like a couple of doctors arguing over which brand of cough syrup to give a patient without ever bothering to figure out what's causing the cough in the first place. Okay, so look at this. This slide really breaks down the whole misunderstanding. The common view, the one you hear a lot, is that high interest rates are the cause of economic pain. But the deeper reality, the one economists have understood for decades, is that high interest rates are actually the result. They're a symptom of a much bigger problem, a broken economic engine. They're the fever, they're not the virus. And the thing is, this isn't some wild, controversial new idea. As the source material really hammers home, this is a settled debate. This discussion was basically finished 50 years ago. The idea that you can fix a fundamentally weak economy by just artificially forcing interest rates down, it just doesn't work. The real problem is a lack of actual production, of real value being created. All right, so if it's not about interest rates, then what is the real source of a currency's value? What is that deep underlying engine that actually drives a nation's economy forward and makes its money worth something?
Well, the source we're looking at lays out this really powerful idea called the civilization cycle. The argument is that real, lasting economic value doesn't just appear out of nowhere. It flows through a sequence, like gears in a machine. It all starts with an environment of free thought and open ideas, that then leads to scientific discovery. That discovery fuels new technology, which then enables the production of valuable things. And holding all of that together, you need a predictable rule of law and a shared culture.
Here's a great way to think about it. You can't just airlift a brand new high-tech Apple factory and drop it in the middle of a country and expect it to magically work. It won't. Not if the foundational pieces, the educated workforce, the scientific know-how, the legal protections for property and ideas, aren't there to support it. It's like trying to plant a delicate orchid in concrete. You have to build the entire ecosystem first. So let's put it all together. When you think about a major currency like the US dollar, what's really holding it up? Sure, day-to-day economic policy is important, no doubt. But what's more important is the raw productive power of the economy behind it. And what's truly fundamental, the absolute bedrock, is that whole civilization cycle we just talked about. The universities, the research labs, the courts, the whole culture that powers innovation.
Okay, I know what you might be thinking. This all sounds kind of high level, a little abstract, right? So let's bring this right down to earth, to the most personal level imaginable. Because at the end of the day, all of this, it boils down to one simple thing we can all understand: trust. And that trust is all tied up in a feeling of ownership.
Just look at this. This is an absolutely staggering statistic. Inside Turkey's own banks, the majority of people's savings, 55%, aren't even held in Turkish lira. They're held in foreign currencies. Now think about that. This isn't just a financial decision. This is a massive nationwide vote of no confidence cast by the very citizens the currency is supposed to serve.
So why would people do this? It's because they simply don't trust that their own currency will hold its value. This points to a much deeper feeling, a sense that the institutions that are supposed to protect them and their money, the central bank, the government, are somehow ownerless, that they aren't really working for the people. It's a fundamental breakdown of the social contract.
And this brings us to what might be the most powerful, most personal idea in this whole explainer. When you walk down the sidewalk in your country, that paving stone under your feet, it isn't just some abstract government property. A tiny, tiny fraction of it is yours. The central bank is yours. The national treasury is yours. And that feeling of collective ownership, it's absolutely vital. Because when people lose that feeling of ownership, when they start to believe their institutions are ownerless and disconnected from them, they lose trust. And when that trust disappears, no amount of money in the world, not even $128 billion, can artificially hold up the value of a currency. Trust is the invisible, essential ingredient that makes money money.
So it all comes back to this one final question for you to think about. It's not just about the numbers printed on the bills we carry. It's about all the invisible things: the trust, the productive power of the nation, the rule of law, and that shared sense of ownership. So, what are the invisible foundations holding up the value of the money in your pocket?